You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Well, if it's Saturday, we must be talking real money. And just to let the control room know that I'm not getting the mix minus. I'm getting me feeding back through the headphones. I assume you guys know how to fix that. I'm going to go with, yes, you know how to fix it. 855-935-TALK is our number, 855-935-8255, to talk about, guess what? Money, how you manage it, how you spend it, how you invest it, how you save it, how you lose it, the dumb things you do with it, the smart things you should be doing with it. We got lots of those to share with you, those dumb things like hedge funds. Can't wait to get to this one. This is one of the most fun things we've had in a while. We do love making fun of hedge funds, don't we, Tom?
Well, it's an easy target, so we can do it. Why not?
Yeah. Oh, and by the way, control room, I'm not hearing Tom. I'm just hearing me. Not Tom.
Well, that's very upsetting.
It is, because I don't know what you're saying. So we're just going to... Yes? Control room is back. I'm hearing Don McDonald coming back to Don McDonald. And Tom, did you break the mic? It was just working.
Oh, you have to. Is it on? As they always say when I call for technical support.
Oh my gosh! You didn't turn it on.
They always say, "Sir, is it in the on?" Oh, okay.
Sir,
I'll get back to you later.
Is it plugged in?
All
sir?
right. Funny.
Oh,
so,
that's hysterical. Yeah. No, really, you didn't turn your mic on.
Well, do I sound better with it on or with it off? I guess that's the question.
I'm going to stick with you sound better with it on.
Oh, that's very kind. So, yes, we will get to hedge funds.
You sign the checks.
Yeah, we'll get to hedge funds. The big checks, apparently. We'll get to hedge funds. We'll get to wooden nickels. We got all kinds of fun stuff in this program. We really do.
We do.
But I hate the unfun stuff that we have to read all the time. Did you give the phone number, by the way? I don't think you did.
I did, but you weren't paying attention.
Right.
You were trying to figure out which switch
Why
to
is the
throw
mic
to turn
not
your
on?
mic
Yeah.
on. Hey, is it plugged in?
Yeah, is it plugged in?
855-935-TALK. And that number is really special in that it allows you to ask us questions 24 hours a day, 7 days a week, whenever the spirit moves you. But for 2 hours on Saturday, it's a live, inexpensive, interactive. I'm trying to think of another word that starts with
interactive, inattentive, incredible,
intelligent.
Okay, yeah, because incredible could go either way.
Discuss money.
Yeah, I was saying reading the painful things, because this is a huge article in the Wall Street Journal talking about, and the number is astounding. For those people 65 years and older, which I used to think was really old, but now as I approach it, I don't think it's that old. A third of you, of us, me, almost me, bailed out of stocks entirely. Let me say that again. For those of us 65, I should think those of you.
You're not over 65 yet.
I know. I'm trying to be kind.
I'm not even.
I know. I'm trying to be kind. A third took all their money out of stocks. And the article centered around an ophthalmologist named Dr. Craig Sklar, who said, I don't have 10 to 15 years left to recover my losses, which is how I feel when I go into surgery with him. No, that's a whole other thing. I'm kidding. No, I mean, here, in all seriousness, yes, you do. Sure you do. You should be exposed to stocks at some level your whole life, probably, because that's where you're going to get the stuff that's going to move you ahead of inflation.
You see, but the thinking is black and white, Tom. It's a black and white thinking. It's that if I'm in stocks, then I'm going to lose a lot. If I'm out of stocks, I'm not going to lose a lot. And there's no shade of gray in there.
That's the problem. Right.
Yeah.
People say, well, my portfolio's down. I just looked at a 60-40 portfolio year to date, 60% in stocks, 40% in bonds. You're down to about 10%. Has it been fun? No, it hasn't been fun, but that's not significant.
And that's a number from which you are very, very likely to recover unless, and there's only one scenario in which we're not going to recover in 15 years, Doc.
Guess what it is?
That is the total and complete destruction of the global economy. If you honestly believe COVID is the next zombie maker, or the first zombie maker,
yeah,
actually, we've never had a zombie
TV
apocalypse.
shows, yeah, I don't think so.
Yeah. Then you'll recover within 15 years. You just have to make sure you built the right portfolio.
We'll talk more about
you.
this. It's an important topic.
And that's what we want. Yeah, that's what we want to get across. Build the right portfolio. Don't play games with your money. 855-935-TALK is the number. If you want to know how to build the right portfolio for you personally, give us a call, and it's free.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
You have an issue with money, you need to call us at 855-935-TALK, 855-935-8255. And that did not fix it, by the way. Just to let you guys know.
Okay.
I'm still getting me back.
You sound good.
855-935-8255. Give us a call, and we'll try and solve some of your financial issues, particularly those that relate to investing. And that's a place where a lot of you make some really bad decisions because you have it in your head that this process of investing is black or white, it's in or out, it's up or down, it's not a zero-sum game.
And that you need to respond to things. In other words, when all this broke loose this spring, I got to do something. I got to move money out of stocks into cash. We'll talk about the numbers, which are astounding. There's been a lot of people that have decided to become traders, right? That they're going to buy and sell individual stocks because this is a time.
Traders to investors everywhere.
Exactly.
Oh, different kind of trader.
Yeah. Well, I was glad to see that the SEC suggested to Hertz that, maybe you shouldn't issue stock that while you're perhaps heading into a bankruptcy, that would be kind of misleading. Yeah. That was kind.
They did pull that.
But, I mean, so this is, again, the number, one number is the fact that those over the age of 65 sold 1/3 of all of their stock. Another 1/3 of those people got completely out of the market. That is not a correct approach to investing. Your investments should match. We've mentioned this before. How much volatility you're willing to accept, how much up and down, right? What rate of return you need, right? Mm-hmm. That's pretty important.
And this is something that very few in our industry talk about. They may talk about risk, but even that, very few people want to talk about. They want to downplay the whole risk thing because that'll scare you. But very, very few financial planners and investment advice providers ever ask you, how much risk do you need to take? Why take more than that? Great point, Tom.
Thank you. And number 3, by the way, we have a risk quiz that we offer free online, and we have one in the office that involves electrodes. That we turn up to a certain amount. And testing people.
Tom, it's only in Tom's office because he gets a kick out of it.
Bring the advisors in, hit them. Number 3 is how long until you need the money. That's what the doctor said. He said, I'm 62, which is the same age I am. And he said, I don't have 10 to 15 years left to recover my losses. Now,
Tom, I'm sorry to hear that you don't have 10 to 15 years left.
That's a whole other If my daughter keeps baking every day the way she does, probably have 10 to 15 months. But the fact of the matter is he should be balanced between, as you said, many people think investing's all or nothing. I got to be all in stocks or I got to go to cash. You should be balanced between stocks and bonds. Say, for example, he had a portfolio of $1 million and he had 60% of it in stocks, 40% in bonds. He would have been down 10% year to date, right? And he would still have $400,000 if he decide to retire next week to start drawing money to pay his lifestyle. He'd have a lot of years of payments from that before he had to draw on the stocks at all. Period.
Let me just carry that a couple steps farther, though, because you talk about that 60-40 portfolio, and for some people, that may be too risky.
Yeah.
But if he had a 20-80 portfolio, 20% in stocks, 80% in bonds, his returns would be reduced a little bit. But it's really, over a long period of time, it's only a bit. And the losses would have been, well, close to non-existent. Let me look them up. I should look it up.
I could get that number for you very quickly, but I can tell you.
You have it?
I can get it right now. Watch this.
I can get it as fast as you can.
I don't think so. Why?
Oh, okay. Maybe not. I'm usually faster on a computer than you are.
You are, but I know where to go to get this.
Okay. The reality, though, is that there is middle ground, and there's a lot of middle ground. It's the whole middle between 0 and 100. And we, as investors, often tend to think black is 0, white is 100. Things look good, I'm 100. Things look dark, I'm out.
And by the way, so I just looked up the number. Our friend Mark Hebner updates this every day at his website, ifa.com. We'll give him full credit. I think it's a wonderful service in many ways. So year to date, a portfolio 30% in stocks, 70% in bonds. That's what you were asking about?
Well, I said 20-80, but let's use
20.
30-70.
Well, 20. Okay, 20, you've lost 3.3% year to date. And
almost
by the way,
nothing.
you make a great point. Over 92 years and 5 months. How does he get the data? 92 years and 5 months, you've compounded at 5.4%. That's a pretty good return for only 20%.
It isn't half bad because it's only 20% in stocks.
So the doctor, if he can't take the pain of, stock market volatility, could at least be in 20% stocks, 80% bonds. So he has some shot, because I'm leading up to the other tragic part of this whole story. And that is now the number. You know how much money is in money market funds right now?
Oh, it's way too much. It's a trillion or something.
4.6 trillion. Never been higher.
5 trillion?
Never been higher.
My
ever.
gosh.
And it's grown substantially. It's added about $1 trillion in the last 6 months. I mean, this is too easy, right?
Do you know what's interesting about that number? Is the fact that it answers the question that people ask, all these analysts. Well, how can the stock market go up in an economic environment like this? Cash.
Yeah.
Sitting on the sidelines,
Did you imagine
literally nothing.
Literally your money market fund today paying, 1/3 of 1% or something. I mean, it's tiny. The number is awful. But people say, well, I went to cash because the market went down.
And I'm going to get back in as soon as it goes back up.
That's one of the problems, right? You got to be right twice. You got to know when to get out, when to get back in. It's not the way to have your money managed. It's not the way to take care of the money yourself.
Well,
period.
What's curious is I've run into a number of people who said, oh, I was so right not to get back in because, that rally just a fake you out rally. It's a big dead trick. Cat bounce kind of a upside thing. And because what you do is you watch it go up after it goes down and you go, yeah, but this isn't the real rally yet. You always second guess everything on both sides, both directions, until you capitulate at one end or the other. It finally gets so bad that you can't take it anymore, or gets so good that you go, darn it, I should have gotten in a long time ago.
If you're holding cash, it suggests you know something about the future, right? Because the only reason to go to cash is you're saying, I'm waiting for Boeing to go back to $100 a share. I'm waiting for the S&P 500 to go back down by 20%. I'm waiting for fill in the blank. Nobody knows that. Your portfolio should be built for the things we already discussed. Nobody knows.
But it's the I'll know it when I see it.
Yeah, well, me too, by the way.
Yeah. I'll know it when I see it. The problem is that is not supported by any factual information.
That's the problem.
No study on the planet
but it feels
shows
good.
that you did it.
I went to bed. I had $128,000 in my account. Guess what I got up next day? I had $128,000 still in my account. It feels so good.
But the problem is you got out when it was $175,000 and it went down to $128,000. That's when you got out. 855-935-TALK is our phone number. Please call. We'd love to talk with you about your money.
Don are talking real money.
Most of you get really bad investing advice, but it's not your fault. The fault lies with a broken business model that dates back more than 100 years and some misguided investing attitudes. If you're ready to start investing and stop playing with your money, you need to find a way to bypass bad brokers and find full-time fiduciaries, which just happens to be the name of our next free online class, July 1st at 8 a.m. Is your financial advisor always required to act in your best interest? Are you paying them huge commissions? If you have a fee-based advisor, do you know how much they charge? And is it fair? Do you have a hodgepodge portfolio made up of a variety of hot tips and changing strategies? These are just part of what you'll learn during our Zoom class, Bypass Bad Brokers and Find Full-Time Fiduciaries. Register now at TalkingRealMoney.com. In addition to banishing bad brokers, we'll tell you exactly what you need to look for in a 100% fiduciary advisor. Save your spot at Bypass Bad Brokers and Find Full-Time Fiduciaries at TalkingRealMoney.com. Click on the events button. That's TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And this goes deeper, Tom. This goes deeper. Oh, I just got my mix minus. Oh, it's a miracle.
You look so much better with it. I have to say, it's good for you.
I got to turn you down there.
Thank
so
you.
I don't get you in two places. Anyway, 855-935-TALK is our phone number. Anyway, the point I'm going to make is this goes back to terrible guidance from the financial services industry, Tom. This is really what it is. Because there isn't a focus among financial advice providers, and I don't even want to call them financial advisors because it makes them sound more important than they are and more qualified than they are. But there is a lack of guidance of explanation behind how investing is supposed to work and how it needs to work for each individual. There are out of the million advisors out there, there's just a handful who actually do this.
Most of them are more like Chris Zaccarelli, who's quoted in the article. He's with Independent Advisor Alliance. He says he's holding more of his portfolio in cash than usual. Why? He says when he scans the market for high yield and investment grade corporate bonds, he hasn't spotted enough appealing opportunities to invest. And that's what I was saying about cash. If you're holding it, you're waiting for something to come along that screams, I got to put my money in that. And that has not been a profitable strategy for a long 92 years and 5 months, a long time. In other words,
I'm trying to understand. Wait, this is an advisor, a financial advice provider?
Yeah.
Who said this?
Yes.
I scan the market and I can't find anything that looks good.
That's the quote.
Wait. Does he think that there are bargains just sitting out there waiting to be found, that he's going to be the one to find them, that there is this great high yield investment that the rest of the millions and millions of people who buy and sell stocks and bonds haven't already found? If such a thing existed, does he really think it would go unpurchased for more than about a thousandth of a second?
Yeah, that's the problem, right? That most of the trading is done by people above Chris's pay grade. Well, by the way, at least he has a website. I looked.
The market is broadly, exceedingly efficient. there is truth to the efficient market hypothesis. Where we get into trouble when people say, well, the market's not efficient, is that there will always be minor inefficiencies. Something will be priced a little low at a time based on what it's really worth, like a value stock. But there are people out there who are working actively to take advantage of any inefficiency they can get their hands on, and they're doing it with more information than you have, with faster equipment and better connections than you have, and they're willing to lose a lot of money, if need be, to make those little skinny profits. You and your idiot advisor can't hope to compete with that.
And we've got the data on the people, the really smart people that are that are really doing that for the more wealthy among us. We'll talk about that in a few minutes because it's fascinating how well they have all done and continue to do, which
and
isn't
plus
very well.
they're even offering their incredibly terrible but fancy-fied services now to people with less than millions of dollars.
Yeah, no, they're making it simple for us little people to get involved.
Yeah, little people, $25,000. You can invest like the big guys.
And they got the mouthpiece who used to be the mouthpiece for the resident at 1600 Pennsylvania. So he's anyway. We'll get to that in a few minutes.
Runs it.
Well, no, that's
doesn't
true.
the mooch run it?
I think he does. Yeah, you're right. But hey, let's finish this thought. Isn't
that a Queen song? Scaramucci.
We at our class on July 1st, minor promotion here. We go through all the things this industry does to confuse it, to make it obfuscate. And this is part of it, by the way. That here I'm holding cash because I'm waiting for something. He doesn't know any better than you do. Absolutely not. Trust us. Doesn't. But you need to have the right asset allocation. You need to have a plan that says ups and downs are going to be part of the deal. Here's how long I need till the money. It's all part of a plan instead of a reaction to whatever's happening.
And I got to tell you, most advisors don't like doing plans because they interfere with selling. It just takes time away from going out and selling stuff to be able to afford the Maserati or the Bugatti or the whatever fancy car they're driving. 855-935-TALK.
And Don are talking real money.
You've heard that about 99% of all financial advisors are not always required to act in your best interest. You've probably been pitched financial products by all manner of friends and relatives, and the investing you have done is probably a hodgepodge of ill-fitting pieces that are doing little to provide the financial security you need. If you're looking for a 100% pure fiduciary, and we'll put that in writing, low-cost, fee-only advisor who always puts you first, give Vestory a call at 800-386-3004. That's 800-386-3004, or visit us online at Vestory, VESTORY.com.
Reality radio for a really great future. We're talking real money.
Real money is really important, and real money, the reason we use the word real is because there is so much unreal information being promulgated throughout this industry, in the financial press, in the financial media, from financial advice firms, just really bad information and often terrible advice. So we want to help you work through that. Find the right path to the future you need at 855-935-TALK, 855-935-8255. Just call us. It's free, and it's so blasted easy.
And
give us a call, 855-935-TALK. Yes?
If you do it, we're going to give you a free ticket to our webinar for July 1st. Yeah.
Yeah. It's already free. But okay.
Well, okay. All right.
I don't like being misleading.
I don't. I was kind of having fun.
I don't like being misleading.
Yeah.
Let's talk.
Misleading.
It's time. We need to do it. We need to take care of this. We need to get it out of the way.
What's that?
No, the target date fund.
Oh, that's right. Yeah. So I did a podcast a few days ago. Let me just back up, because target date funds, it's always been a struggle for me, because target date funds, generally, you own mostly large U.S. companies, right? Mm-hmm. Mostly.
Yeah, it's true.
You really don't have much, as we would say in the business, exposure. Your money's sort of exposed to more value stocks and small stocks that have made you more over time. But
I knew there was a but coming.
Well, because
I knew it.
If it's, as my son said the other day, so if we can finally get them to invest, and it's just they don't know anything about this, but they put it in target date fund. That's good. And I think
than nothing.
I think I
Better
also
than
praised
nothing.
on my podcast Paul Merriman's approach, which is the target date fund plus owning a small or small value fund in your 401k if you have it. But they inevitably, when the market goes down, they get this criticism like, well, they didn't protect you. Yeah. Well, one fund didn't act like the other. Mm-hmm. And
Because they're run by different people.
well, yeah, Liz Weston, who's somebody I read and I respect her work, but she sort of picked on the target date funds and the differences of returns between different companies that run them, Fidelity, Vanguard, T. Rowe Price, et cetera. So I took it upon myself to look into this, to do a podcast on the fact that I think if you really look at them, I looked at 2025 because I think that's kind of a, if you're within 3 or 4 or 5 years of retirement, that would be the fund you're in. So on my podcast, I actually dove into the T. Rowe Price 2025 fund, the Vanguard 2025, and the Fidelity 2025. But I made a mistake.
Yes, you did.
I did. On the Fidelity fund, I used the Fidelity Freedom 2025 fund, which is an actively managed fund. And it's a lot more expensive than the index fund. Instead of the FFTWX, I should have recommended the FQIFX, which is the Fidelity Index version, which is only 12 basis points. Very inexpensive, cheaper by 1 basis point than the Vanguard fund, and basically the same allocation. By the way, these funds are basically the same allocation. I know they're not exactly, but
Because if they're indexes, they're really close.
they're close. They're about 60% in stocks, 40% in bonds, which I think is a very reasonable approach to somebody retiring in 5 years. Very reasonable. So I don't agree with the criticism.
Here's what I'm going to do
Please.
for you, Tom.
Thank you.
I am going to apologize for the entire staff of Talking Real Money to the folks at Fidelity
Oh, no.
for Tom not giving you the credit you deserve, because you deserved more credit than he gave you.
Okay.
So
Fair enough. I feel
we
good.
feel bad.
I do.
I'm looking at I found a Target 2025 fund that has an expense ratio of 60 basis points.
Well, T. Rowe Prices is 65. 62.
Really?
Pardon me. Yep.
Oh, that's ridiculous. Yeah. All right. 855-935-TALK is our phone number. We do have a couple lines open, but we're not going to go to the phones yet because we don't have time before the break.
Then let's not. The bottom line on a target date fund is if you know nothing about investing, if you just want to turn over your asset allocation, your stock to bond ratio to somebody else, this is probably the best approach for you. Really is. Can you get can you do it better? Yeah, but this, if you don't want to deal with it and you just want to put the money in every 2 weeks, it's okay.
And it's nice for those who are, and we say this about index funds from Vanguard and the like, just setting up portfolios there anyway. It's a good place to get started. When your portfolio grows, when your financial life becomes a bit more complicated, that's when it starts to make sense to look to the more complex portfolios, the ones that might have the potential to eke out those extra little percentage points. 855-935-TALK.
And Don are talking real money.
Did you know I wrote a book? Yeah, about 10 years ago, I wrote a book about investing. Financial Physics, with an F, How Money and Investing Really Work. It's a short read. It's a really easy read because, well, as you know, investing is way too easy to be this complicated. And it's been on sale for a long time at Amazon. I updated it in 2018 to a new version. But if you don't want to buy it, you can go buy it at Amazon. It's $10. But if you don't want to buy it, if you want it free, well, you can get it free 2 ways. One, you can get a PDF copy by going to talkingrealmoney.com/free. talkingrealmoney.com/free. If you don't put in the /free, you can't find it. The other way is if you have an iDevice, like an iPhone or an iPad or a Mac, you can go get an interactive version of the book, a special edition that I made that's actually interactive, that's got videos and motion and things going on, and that's also free. Just look for Financial Physics, FYSICS in the Apple bookstore or Apple Books or whatever they call it now. Or go to talkingrealmoney.com/free, talkingrealmoney.com/free. And I guarantee you'll enjoy the PDF or the iBook or your money back. Check it out, talkingrealmoney.com/free.
For your real life and real future, Tom and Don are talking real money.
Hey, before I forget, I got to say happy Father's Day to you, too, by the way.
Oh, yeah, it's tomorrow,
It's
isn't
tomorrow, so I hope it'll be something. I don't think you're going to be seeing your kids, though, right? Because you're kind of away from them.
No, it's okay, though. I mean, I've got one in Pennsylvania, one in Florida, one in Arizona, and another one in Florida, but another town in Florida. So 2 in Florida. Yeah, they're all over the place. And I'm in Virginia right now.
You've done a good job with them. I mean, you passed the Chris Rock test. You're okay. So
I have no strippers.
There you go.
Not a stripper in the family.
You're good.
It's really good.
Yeah.
Yeah, I did watch Billions. I did finally see the Chris Rock test.
It was a good one.
I love Billions. I do. I love it.
Show.
I love it. It's got so much inside.
Indeed. Yeah.
I get stuff out of it every time I watch it about our horrible industry and how bad so much of it is. Anyway, wanted to mention something. Speaking of target date funds, just so you know, the Target Date 2025 fund that you mentioned, as you said, is about 60% stocks.
Yeah.
And about 40% bonds.
Indeed.
Because it's anticipating you getting into retirement. And again, it assumes everybody of a particular age has the exact same tolerance for risk, which is not the case.
Yeah, right.
But I did look. I was curious. I wonder what the Vanguard 2015 Target Date Fund has in its portfolio right now.
40-60.
Exactly.
Oh.
You nailed it.
Boom.
Exactly.
That's it. I'm
40-60.
Yep. Okay.
Yep. So you see, the 2015 people are already several years into retirement. So now their portfolios become more conservative.
And they're down like 7% year to date. Oh, it's horrible.
Yeah. I forgot to look at that.
That's not bad. Are you going to go to the phones or what are you going to do here?
Nope, I'm not, because nobody's there.
Oh, well, that's easy. Then don't go to the phone. So,
we're not going to go to the phones.
I'm trying to figure all this out. So I think this is a really important point. I'm glad you raised it. Because moving as you do, hopefully, from work to retirement, in retirement, getting a little older, et cetera, having a glide path of some kind, right? Moving from riskier things to less risky, I'm okay with that. What I'm not okay with is, hey, the market just tanked. I got to sell and move $4.6 trillion to money market. That I'm not okay.
You mean have a discipline.
Have a disciplined approach.
Have a disciplined approach.
And that's what these target date funds are doing. They are moving to less risk over time. Right?
By the way, I hate to break this one to you.
Uh-oh.
You were so right with the 40-60 portfolio that I hate to tell you were wrong.
Oh, on the return?
About the year-to-date return.
Which is?
You were way wrong.
Okay.
It was positive.
At least my kids show up on Father's Day.
They all live with 2 miles from your house.
But they're going to be here, whatever your reasoning.
Yeah, it's because you hold out little snacks for them. Here, children, Daddy's going to feed you. And I go, feed your damn self, child.
Well, you're better,
anyway,
Dad.
How
much?
0.66.
So they're up
positive.
Almost 1% year to date.
Yeah.
Big deal.
Pretty impressive.
Yeah. No, there's nothing.
That doctor would have felt better with this portfolio.
You pointed out, though, I think the doctor feels, like a lot of people, I'm either in stocks or I'm out of stocks, depending on what's going on. World looks like it's come to an end, I'm out. World looks great, like 1999, oops, or like 2007, oops. Then, this is the people have it's all backwards. Your brain works against you, as Jason Zweig wrote in his terrific book.
Oh, what a terrific book, too. Our brains are binary. That's why we're so good at right or wrong. There's no gray. It's either right or it's wrong. You're in or you're out. It's not binary. It is.
Exactly.
I've always held that the truth about almost everything lies really close to the middle. In everything, in money, in politics, in everything, the truth is somewhere near the middle. It's rarely off to either extreme.
This is the problem.
I'm going to get in trouble with people on both extremes, but I believe in the middle. I'm a big believer in the middle.
I think generally with money decisions, which people
The
make
middle's a better place.
Yeah, it is. People make a lot of them without really thinking through all the ramifications often. Like, for example, we've been talking a little bit about this, about the young people that have been investing in individual stocks. We had the tragic story this week with the fellow that got all the margin from Robinhood and then took his own life, right? I mean, these are, no?
Oh, that one.
Yeah.
Oh, yeah, no, okay. I'd forgotten about that one. Yeah.
Somebody else sent it to me again last night, and I said, yes, we've read that. But the point is, that is a radical approach to investing that people try, and we'll touch on this next hour with hedge funds, that doesn't pan out over time, and yet people believe that to be investing. They think it's the right thing to do right now, especially because stocks are down. Yes, you should have a disciplined approach to buying a globally diversified stock portfolio all the time if that's part of your strategy. If it's not, then you wouldn't be all of a sudden changing your mind because the market went down. Oh, now we have a call.
And by the way, just to add real quickly, before we go to Dave, it is never, ever a good idea to use margin to invest.
Thank you. By the way, that's one of the reasons the market crashed the way it did in 29. Margin was about 80%, was some ridiculous
90%.
Whatever it was. Yeah, it's nowhere near that
borrowed
today.
money.
It's like 5% today or something.
It's
right?
very
tiny.
small.
Yeah. Anyway.
855-935-TALK. Give us a call. And Dave, it's your turn. Welcome to Talking Real Money.
Hey, guys. Appreciate the show. Couple quick questions for you. We've got a couple girls. They're both mid-20s or so, and they've just finally gone from that stage of a couple of starting jobs into what could be career opportunities. And I'd like to get them started not only with making sure they capture any matching funds within their employer's programs, but also get them setting something outside of that, because they're going to be, everybody's moving. Nobody stays employed with the same group in this era. So you've mentioned a couple of Vanguard global funds. I think VT-WAX is one of them. Yep. And a bond fund that, someone could start and mate those two and take the risk analysis and basically get a foothold. And what I'd like to do is get the girls going on that and making those monthly dollar cost averaging contributions, so that in 10 or 15 years, when they land where their real career might end up, they've got a real nest egg there for their future.
Smart. I hear smart all over the place. I think the best gift you can give a working child, period, bar none, are contributions to their Roth IRA.
Yeah.
To a Roth IRA, tax-free. They generally don't need the tax breaks. They're not making enough money yet. Tax-free growth for the rest of their life. And when they're young, I'm willing to bet if they take the risk quiz, it's going to say that they probably should be 100% in a fund like Vanguard Total World Stock Index, VT-WAX. I would suggest you set up a program to fund that as up to the point you can afford, or tell them, you put 100 in, I put 100 in.
I think that's great. By the way, what is the income limit, I forget, for an individual for a Roth IRA, Don? Do you know that off the top of your head?
No, it's probably not where they are.
Yeah, they have to make...
Not at the beginning of their career.
Do they make more than $100,000 a year, Dave?
No, they're both going to be about mid-40s.
Oh, then they're all set. Yeah, I mean, I love Don's. I think the 100 from one and 100 from another, you participate too. I think that's great. They can save all the way up to the $6,000 for the Roth IRA. Would be terrific.
And then every Christmas and birthday, a nice $500, $1,000.
Dave, you are on it, man. You've been listening.
You are going to set your kids up literally for life by doing that now and keeping at it over the next 10 to 15 years. Thanks for the call. 855-935-TALK.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Again, most of the financial advice provided by the financial advice industry is terrible. Most of it. Some of it's really good. It's just figuring out how to get the good advice that's tough. And that's why we're teaching a class, an online Zoom class, really easy to attend, really inexpensive as in free. And we're doing it on July 1st, so you can declare your financial independence just before Independence Day. All you need to do to register is go to talkingrealmoney.com, click on the events button. That's talkingrealmoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.